Welcome to Accounting 201 Financial Accounting at Kapi'olani Community College. Before we get deeply into Chapter 2, I want to give a quick recap of what we did in Chapter 1. If you recall, when we were given transaction descriptions, we picked the accounts involved in the transaction, decided whether the account was getting bigger or smaller, and then recorded them under columns. However, once we were done totaling up the amount of change in each column, we then went through and prepared financial statements. This is great for a small little company with like one sheet full of transactions. However, for a company with many accounts and many transactions, this just won't work. Thus, we have to adopt the traditional form of accounting that's been used for about 1 millennium, and that is double entry accounting. In double entry accounting, we use accounts, just like we use columns in Chapter 1. And this account here, I don't know what kind of account it is. It's the any kind account. But every account, or any account, will have two sides to it, a debit side and a credit side. So debit really, for our purposes, just means left, and credit just means right. When you make entries to these accounts through the standard procedures, you end up with typically more dollars of entry on one side of the account than on the other. The account that has the heavier amount or larger dollar amount of entries on it determines what the account's ending balance is. So the ending balance is the difference between the debits and the credits on whichever side is larger. In this case, credits larger than debits by $30, so the balance of the account is $30. This is what's known as a T account. T account is the simplest possible way that we can use to show a journal, a ledger. Now, in double entry accounting, we use this to preserve the equality of the accounting equation, just like back over here when we went in and decided to make sure that every time we made an entry in here, the entries on the left side of this equal sign were equal to the entries on the right side of this equal sign. However, now we'll do that by making sure that every time we make an entry to an account, or in our accounting system, that we'll have equal dollars of debits and credits in that entry. So how do we make sure that that happens? Well, somebody a long time ago cleverly figured out the relationships between accounts and those that tend to be involved in the same transaction. And they set up the rules for which accounts should go up by debits and which accounts should go up by credits. And the way to make any account go down is the opposite of however you make it go up. It's really simple when you break it down to its elements, but it's pretty complex in practice. So if we look at all the kinds of accounts that we've looked at before, we have assets. Let's make a separate category of accounts here for dividends, expenses, liabilities, anything inside of the stockholders' equity section, and revenue. So stockholders' equity would include accounts like common stock and retained earnings. If you look at the accounts on the left-hand side of this equal sign, this is really just our expanded accounting equation rewritten with only positives. So there are no minuses in here, only pluses. Accounts on the left side of the equal sign go up by an entry on the debit side. Accounts on the right side of the equal sign go up by an entry on the credit side. And the balance you would normally expect to find, or the normal balance, is on the same side as where you make increases. Well, how do you make an account go down then, or decrease? You just do the opposite of whatever is required to make it increase. So what do we do then? We make journal entries inside of something like similar to a diary called a journal. And the journal is also known as the book of original entry. We enter transactions here as they happen, chronologically, and so everything's arranged by date order, and the journal entries always indicate the amounts and the accounts by which should be debited or credited. In other words, those accounts and the dollar amount by which they should change that are involved in any transaction. So what do? Same thing as you did in Chapter 1, where you went through and you picked the account you wanted to debit, or increase or decrease, put a dollar amount under there, whether it be increase or decrease, and then pick the other account that had to be involved. That had to be a minimum of 2 accounts, and at least one of them has to be either an asset or a liability, and then made sure that the entries resulted in maintaining the equality of this expanded accounting equation. So same exact process, pick the accounts involved, decide whether they're getting larger or smaller, but now you have to translate that increase or decrease into whether it should be a debit or it should be a credit for each individual account. And whether it should be a debit or a credit depends entirely on, does the account get bigger or smaller, which you've already decided, and next, what is the normal way of making that account get bigger or smaller, which is different depending on which side of this equal sign you're on. So assets, dividends, expenses, up by debits, down by credits. Liabilities, anything in stockholders' equity, revenue, up by credits, down by debits. So once we've done those entries in the journal in chronological order, then we kind of dissect the journal entry and take the individual pieces of it, the individual debits and the credits, and we recopy those dollar amounts on the same side as we indicated in the journal entry to the ledgers, the place where we keep our account balances. So before we got to make an entry and be able to tell the account balance just by doing a new subtotal on our sheet here, but now we're going to have to do a separate process because we're going to separately maintain where we record the entries from where the account balances are kept. Entries will be made in a journal, account balances will be kept in a book called the ledger. So how do you get a new balance? It doesn't matter whether we're talking about an account that goes up by debits or credits, the work is still basically the same. Whatever the old balance was, be it debit or credit, add any amounts that were increases, which depends on which kind of account it was and which side the entries were made on, and subtract any entries for which there were decreases, and then you got your new balance. Now, how does this work in practice? Let's take a look at this. This is a recap of our debit and credit rules with our expanded accounting equation kind of in the order that you recall seeing it in. Notice it has the minuses in here and lots more accounts on the right side of the equal sign than on the left. Let's look at a journal entry. Here's an example of a journal entry here on the right side where it says journal entry. On the left, we have a worksheet that I've come up with that we use to figure out what accounts are involved in the transaction, whether the account's getting bigger, plus sign, or smaller, double parentheses or double pointy brackets, and then you have to translate what kind of account it is. Common stock is a stockholder's equity kind of account. Cash is an asset account. So in this transaction, this was the company issuing stock in exchange for cash. So they issued stock to new stockholders and received cash from those stockholders in exchange for that stock. When we write this transaction, however, we have to decide whether we want to debit or credit the accounts involved. Common stock, equity account going up, that goes up by credits. Cash, asset account, that goes up by debits. So when we write the journal entry, we'll always write the accounts being debited first and then the accounts being credited next. So if there are 3 debits, we'd have debit, 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 and then a credit. Or if there were 2 credits, we'd have debit, credit, credit. So in any journal entry, debits are always first, credits are always last, and we group them together. So there's an example of a journal entry. Really the only thing that is a journal entry is this part over here on the right. The part on the left here is just basically thinking space for you to work out how to come to the final answer that you need on the right here for the journal entry. So back to our little exhibit here. There's our debit and credit rules recapped again with the expanded accounting equation. Every time we record an entry analogous to this over here, where we have to make sure that our transaction or our accounting equation remains in balance, we have the same kind of a thing we have to do here, except we do it by making sure that every time we record a transaction, we have equal dollars of debits and credits. So from the journal, where we make sure each journal entry has equal dollars in debits and credits, to their posting or recopying to the ledgers, where we make sure that every time we do a posting, we end up posting equal dollars of debits and credits. Then we end up with account balances that have total account balances added together of debit balance accounts equals total account balances of credit balance accounts. So everything in the entire accounting system then has equal dollars of debits and credits. Now, how do you do the transferring of information from the journal where we record the transactions to the ledger? You do what's called posting. Here's a better example of a real journal entry. Notice we have the date involved in the transaction. We have the account getting debited, the account getting credited, the dollar amount of the debit and the credit, and a little optional description here at the bottom saying like what this transaction was about. The first step is to find the account being debited in the ledger, a separate book from the journal. Here's the journal. Ledger looks like this, which kind of looks pretty similar, but it's not the same. Okay? There's many pages of journal with many journal entries and all in chronological order. There are multiple pages of ledgers, typically one or several pages for each account, but each account is separately maintained from every other account, so they're not mixed together. They each have kind of like their own page. So when we do the posting process, we recopy from the journal to the ledger, meaning pick up the date of the entry that we're working on, find the account that's being debited, account or accounts being debited, go to the ledger in the general ledger for that account, put the date in there. Don't need an explanation unless it's something like a closing entry or adjusting or correcting entries. Say the journal page that it came from in the reference column, put in and recopy essentially that debit to here. Now if there was no balance in cash before, the balance will now be only $15,000, and we would call that a debit balance because the debit made it go up. Next, we find the account getting credited, in this case common stock. I find the ledger for the common stock account. I put in the date of my transaction. I don't need an explanation for something simple like this one. I put in the journal page that it came from here in my reference column, and that was a credit to common stock of $15,000. So I'll drop that in over here, and because that credit made my account go up, I can now say this account has a $15,000 credit balance. So when you start adding additional debits and credits to each account, some of them will result in increases and some of them will result in decreases depending on which side the entry is made on and what type of account it is you're making the entries to. Once you've gotten your new balances, you should be able to put them all together, just the ending balance only, on one sheet of paper known as a trial balance. A trial balance, in this case a super simple one, say for example we have only these three accounts. A trial balance lists your accounts with debit balances in one column, your accounts with credit balances in another column, and then pulls a total for both columns. If these totals are not equal, somewhere, somehow, along the entire string of events from making a journal entry to posting to the ledger to computing new balances to recopying them to the trial balance to adding up the totals of the credit trial balance columns, you made an error. So you have to go backward through the entire process, try and figure out where you made the error. Typical errors: posting to the account twice, posting to the account and doing the wrong thing with the amount that you posted, like adding instead of subtracting or vice versa, neglecting to pick up an account balance, reading the wrong line, or any other number of things like that and transferring them to the trial balance, or simply getting so excited that you're almost done that you do bad math on adding up your debit column and your credit column on the trial balance. So any one of those things along the line could happen that would disrupt the equality of the trial balance and tell you that somewhere in your accounting process you made an error. You can't just continue on with it. It's not like a Word file that'll do a spell correct. You got to find it at that point. So what do we have all together? What are all the steps we went through? First of all, we want to make sure that you understand that the only time a trial balance proves with absolute certainty that you've done pretty much everything correctly is if you have an answer for a trial balance, which you don't have in real life. So in real life, when you get a trial balance that balances, the only assurance that you can actually get from that is that debits have equaled credits throughout the accounting cycle. Does not prove that you didn't make an entry twice. Does not prove that you didn't skip an entry. Does not prove that you made the account balances go the wrong direction from where they should have. And does not prove any other number of magical properties which you wish it would prove. Okay? The only thing it does prove: debits have equal credits throughout the entire accounting cycle so far. Accounting cycle is the list of steps that we go through in recording and posting and so forth. So what do we have now, given this new technical wrinkle we've introduced in Chapter 2? First of all, for us to do any recording at all, we need a transaction to have happened. And just like when you go to a store, you get a sales receipt, or you write a check for a utility or to your landlord, you receive at least an image of a canceled check back in your bank statement. We generate or receive, along with our transactions, what are known as source documents. So source documents are some contemporaneous or occurring around the same time as document that gets generated. It could be paper, it could be an electronic image. Then we prepare journal entries in the journal, book of original entry, in journal entry form. After preparing the journal entries in the journal, we then post each debit and each credit from each journal entry to the ledgers. As you can imagine, this gets very tedious, and if you're doing homework, my vote, this is the place where you're most likely to mess up your equality of debits and credits, because you get kind of lazy or careless. Next, after getting all your new account balances in each of your ledgers, then there can only be one balance per account, right? It's either a debit or it's a credit, and it's a certain amount. Whatever it used to be, plus any increases, minus any decreases, depending on the kind of account it is. Then we put them all together to prepare a trial balance, looking like this guy right up here. And after we've done a trial balance, then we can prepare our income statement, retained earnings statement, and balance sheet, which looks like, this guy back over here. Income statement, revenue minus expenses. Retained earnings statement, beginning retained earnings, plus net income or minus net loss, minus dividends if we have them, ending retained earnings. Balance sheet, assets equals liabilities plus stockholders' equity. If we have more than one liability, we subtotal and say total liabilities. And it's really nice to call out stockholders' equity here like we did liabilities, and to show that stockholders' equity consists of common stock and our newly computed retained earnings balance, and subtotal and say total stockholders' equity, and summarize both those guys in this major column over here. Total liabilities and total stockholders' equity equals total liabilities and stockholders' equity. Thanks for listening. Hope this helps.